Hello, it's ChewDog Charts. Now, at the end of each month and at the beginning of every month, new information comes out so that I can do a stock market update. You've seen this information before, but we keep looking at it because things change. But before we get to the charts, I'd like to remind you, please subscribe and also hit the notification bell for all new videos. Let's not waste any more time. Let's get to the charts. Now, some of you have seen my previous videos, so there's no need to go into more detail on this information, so we'll be quick about it. But essentially, the market cap to GDP is a long-term valuation indicator that's become popular in recent years thanks to Warren Buffett. Back in 2001, he stated in a Fortune magazine interview that it is probably the best single measure of where valuations stand at any given moment. So if it's good enough for Warren, it's good enough for me. And as you can see here in this chart, we stand at a measure of 133.9, and that's up from the previous reading of 131.5%. As you can see here, for those that want details, the numerator, it's based on the St. Louis Fed information. You can go look it up. And then, of course, the denominator is the nominal quarterly GDP. Again, we call this the Buffett indicator, and it's the corporate equities compared to the GDP. We are at, again, 133.9, which is the second highest reading since 1950. And of course, the highest reading came in the year 2000, right before the dot-com bust. And the second chart here is another variant of the Buffett indicator using the Wilshire 5000 to GDP. On this chart, we're at 131.3, which is also the second highest since the year 1970. The highest was 136.5, which again occurred in the year 2000, right before the dot-com bust. Now, does this necessarily mean that we're about to head down? No. But it does show us that we are at dangerously high levels. Let's go to the next chart. And this chart here is the Buffett indicator comparing the two versions. And as you can see, both charts are very consistent, and I would imagine that the correlation is quite high. Now, what we need to keep an eye on is the movement, of course, in the last few measures. As we can see here, the dots are clustering in this area here. Now, I would normally like to show you the acceleration deceleration chart, but I can't because of copyrights, so I'll just describe it to you. Basically, the last measure on the acceleration deceleration chart showed a slight upward movement, but that's not as important as the fact that these dots here are all clustering and we're kind of moving more or less sideways. So a deceleration with the last measure, a slight acceleration. However, I think we're heading down and we're not below zero yet, but we may be moving in that direction. This chart here shows the Q ratio since 1900. And if you recall, the Q ratio is a relatively popular method of estimating the fair value of the stock market. Essentially, the Q ratio is the total price of the stock market divided by the replacement cost of all its companies. And as you can see here, we are standing at a measure of 1.22. Going back to 1900, that's the second highest, with the highest at 1.60 right before the dot-com crash. And as you can see here, this probably coincides with the 2007, 8, 2009 debt crisis. Going back in time, we've only been up in this range, say over 1, very few times. So again, just a cautionary tale from this chart. And this chart here is the Q ratio percent change from the arithmetic mean. And as we can see here by this black bar, horizontal bar going back to 1900, the arithmetic mean was 0.69. So if we look here at the year 2000, right before the dot-com crash, we see a measure of 133. And that means that it was 133% above the historic average replacement cost. And here, the current measure is 77% above the historic average replacement cost. Also, what is interesting here is this current measure. It looks like we just moved through the second standard deviation line at 74%. So again, we're at the second highest measure going back to the year 1900. And this chart here, for you stock market mathematicians, this shows the same chart as before, but it's the geometric mean. The previous chart was the arithmetic mean. And here we are at a measure of 90. Going back, the only higher measure was in the year 2000 at 150, and then everything else was below the second standard deviation line here. We just crossed through. So what does it tell us? Does it tell us we're having a stock market crash coming up? No, but it tells us it's time to still be cautious and keep our eyes open. And this chart here, which is one of my favorites, is the NYSE margin debt versus the S&P 500. And in the red is the margin debt growth. As you can see, the last measure was slightly higher, and at the same time, the S&P is growing as well. But two things: we need to keep an eye on the absolute measure, which here we're at the highest measure going all the way back to 1995. But we also need to keep in mind the amount of acceleration or deceleration. If we go back here prior to July 1st, 2007, we can see that there was very good acceleration up through that point. And then in the year 2000, through March 1st, 2000, there was also good acceleration at this point before it turned at that time. Now, here we have a clustering, and the clustering is telling me that the acceleration deceleration is slowing, and we actually may be decelerating toward a zero line, and that's not what you want. So for now, that's ChewDog Charts. But before I sign off, remember, please subscribe and hit that notification bell for any new videos. And thank you.